Great. So welcome back once again to the final section. Now we are going to look at ratios analysis, using ratio for interpretation. We've gone through trend analysis, we've gone through common size. Now we are on ratio analysis. How to use ratio analysis. So the same question that we use for the common size, the same question can also be used for the ratio analysis. And the same thing was done in Akwesi Papa. And the same thing was also done in the last teachings. So let's take notes of that. Question that we use for common size, the same question we use for what? Ratio analysis. The same question can also be used for the trend if there are two or more used. Okay. Ratio simple means you are dividing what? Numbers by numbers. That's the meaning of ratio. So as a result of that, we won't ask you what is ratio. No, we won't do that. So great. So using ratio as a tool to provide meaning to the financial statement prepared. Simple means using ratio as a tool to provide meaning to the financial statement prepared. Means that you are going to compute certain ratios, and then we use the ratio, changes in the ratio, to reflect the performance of what? The organization. So most often is the changes in the ratio and then the interaction of the ratio that tell us the company's performance. Good. Interactions or the changes in the ratio reflect the performance of the organization. Good.
These are the interaction
Of the ratios, and then the changes in the ratios reflect the performance of the organization. First of all, you should know the importance of ratio analysis. You should also know the limitations. So number one, important two, limitation. The limitation of ratio analysis. The important, don't worry. If you know the classification, the five classifications, they are the importance of ratio. What are they? They are five in number. Profitability, liquidity, efficiency, and gearing. So ratio is used to assess profitability of the organization, to assess liquidity position, to assess efficiency, to assess the gearing level you are done, and the market position. So if you are looking for the importance of the ratios analysis or uses of ratio, if you know the five key ratios, you can use it as a point. And you can add other ones such as what? After the five main, I will explain them further. You can add something like use it to analyze performance of the company, for decision, to assess risks. So importance of ratio analysis to assess risks. So the other ones are one, to assess risks. Two, to analyze performance. Analyze performance of companies or entities. Three, for decision making. So before a credit facility will be given to a customer, we probably use ratio to analyze the company's, that customer's liquidity position and solvency, so that we can base on it and grant what? The facility to that customer. Good. So that's it. So aside the main five that we know, the five are 1, 2, 3, 4, 5. That's the profitability, liquidity, efficiency, gearing. These are the other important that you can talk about. These ones are just the key ratios. These ones are just what? The key ratios. Good. They are just key ratios. So basically, That is it.
Profitability.
Profitability, liquidity, efficiency, gearing, and market position. So ratios are used to assess or analyze the market position of the firm. So as a result of it, we don't normally ask for the important. We ask for what the challenges, the limitations of ratio analysis. Limitation.
The last one is the market.
Market position. Market position. Okay. Market position. Market position. Good. Market position. Then we look at some few challenges with ratios. Some challenges that we have with what? Ratios. Challenges with ratios. Challenge. I'll give like point changes in accounting policy or account selection of different accounting policy. So accounting policy. Changes in accounting policy or selection of different accounting policy can render this analysis. So challenges or limitations of ratio analysis. Number one, the accounting policy that you selected for yourself can cause an issue in your interpretation or in your report. If it is the same company that you are comparing performance over time trend, like as we saw, if one of the years you change your policy, another year to change it, it will not reflect the true performance of you. You have to use the same policy over the period so that you can know the performance. How we get it? Good. Again, if you are comparing, let's say, two companies together, Diamond and what? Shine. You're comparing the results. If all of them are using different accounting policy, you won't come out with what? The actual what? Performance. Good. Number two,
So how do you put it?
it's limited to changes in accounting policy or selection of accounting policies by two or more different companies. So there are 2 points in here. The change in accounting policy, we can move it from trend analysis and also intercompany comparison. So they said that it is limited to changes in what? Accounting policy over the period. That's for a trend analysis. The same company, but different what? Years. The same company, but different years. Mhm. Then if it is different company, then we will say that it's limited to what? Selection of different accounting policy by the company. So if all of them are using different accounting policy, that's a challenge. It means that we cannot give a valid conclusion. We can't give a valid conclusion because all of them are using different accounting policy to prepare the account. Good. It also talks about accounting information. Now, the information that we use to provide the analysis, it's financial. It does not include what non-financial information. So it does not include what non-financial non-financial aspects. The non-financial aspects, it can be what? Good public image, customer loyalty, product quality, good customer service. All this will not be seen on the financial statements. So it means that when we are interpreting the company's performance, we don't even care whether they are loyal to their customers. What we are interested in is the figures. But meanwhile, it is this non-financial information or non-financial aspect of the organization that translates into the financial. If your product of poor quality, will you sell more to get more revenue and come and record it on financial statement? No. If employees are demotivated because the work condition is very bad, would they come and then give her their maximum best? No. So ratio does not include what? The non-financial aspects of the organization. Because what are you interpreting? We are interpreting financial statements. So if any item that we cannot quantify in financial terms or monetary terms, we are not going to provide meaning to it. Good. You can also talk about always ratio based on past information, so does not reflect the current performance. So does not reflect the current performance. Does not reflect the current performance. Why are you saying this? Ratio. So let's assume that now we are interpreting 2019 financial statement, or even 2020 financial statement is ready. We are interpreting it. If for 2020 we are in 2021, does not mean that if things were bad in 2020, 2020 will also be bad. Or if things were very good in 2019, does not mean that in 2020 we are interpreting financial statement, it will also be what? Good. So that is it. Because it's based on what? Recorded, not future. So that is it. Then we'll add one point to it. Ratios on their own is meaningless. Ratios on their own is what? Meaningless unless compared to other ratios. So the fourth point will be ratios on their own is what? Meaningless. Does not tell us anything unless you compare and know. So that's why I say changes in ratio we don't want to reflect the performance in organization. Good.
Unless it is compared.
To other ratios. Other ratios. Good. So basically that is it. Now let's go straight to the key ratios. The key ratios. Then we look at the formulas very well again. Then from the formulas, we look at the how to provide the report. Then you are probably good to go. So the key ratios, they are key ratios. There are 5 in number. 1, profitability. Profitability. 2, liquidity. 3, efficiency. Or activity. Liquidity is also called short-term solvency. Short-term solvency. Then number 4, gearing. Also called leverage. Also called long-term solvency. Long-term solvency. Long-term solvency. Gearing is also called long-term solvency. Then our stability. 5, market position or investor ratio. Market
And it's also
position.
leverage.
Long term,
No, is it the same as the leverage? Yeah.
gearing means leverage or long term solvency or long term stability. That is the gearing. Then the fifth set is market position. Market position or investor ratio. Market position or investor ratio. So that is it. So definitely you have to pick one of these and talk about it in exams, definitely. So we have to look at the formulas first and how to calculate them quickly. Then when we are done, look at the report, what must goes in the report, basically, to end the ratios section. So let's pick profitability and let us come out the ratios under it. Sometimes your examiner will restrict you or will make the question open. Good. Now, if they don't tell you which choose to use, there's a question then they say, oh, analyze the performance of the company. That's all. Now, what are you going to use? Common size, trend, or ratio? It must be ratios. They don't tell you. For common size and trend analysis, let them inform you before you use them. So that is it. Okay, so let's start with profitability. What goes in there? All this can also be termed as what? The uses of ratio or importance of ratio. These are the five that I wrote. These are assess profitability, liquidity efficiency, sharing level, then market position of the organization. Okay, so we start with profitability. So we look at
The market position is the same as the investment.
yes, market position is the same as the investment ratio. The investment ratio. So market position,
Investment or investor?
that's investor or investment.
I wrote investment. What said investor? I cancelled when I wrote investment.
Good. So profitability. Please, if trend and common size, you are not interested in a formula. But ratios, because they are different, all of them have a different formula we are interested in. So let's get the formula right. Good. So irrespective of the question, just get the formula correct for us. The first ratio on the list will be gross profit margin. Three margin. Now profitability ratio basically talks about your ability to generate what? Revenue and convert it into what? Profit. Good. Your ability to generate revenue and convert it into what? Into profit. So basically, your ability to generate what? Revenue, sales revenue, convert it into profit, which will be distributed as dividend to the shareholders or retained for future investments. Or retained for future investments. That is the that is the profitability. Good. Then the first ratio on the list is gross profit margin. Gross profit margin. The margins are three. Gross profit margin. Three margins and two returns. That make the profitability ratio. Three margins and two returns. You don't need to learn all this. Like for one particular exams, you might not require to do all these five. No. Only few of them. But the danger is that you don't know the one that he will ask you. That means you know all of them. Good. But we will strike out the one that is highly, yes, under each section. Good. So the next one is operating profit margin. Operating profit or margin. Then the third one is net profit margin. Fourth one is the return. ROCE, return on capital employed. Then the last one is ROI, return on equity. So these are the five These are the 5 profitability ratios. Now, let's look at their formulas carefully. All the margins have the same formula, and the return to also follow. Anything margin is that item over sales times 100. Anything margin is that item over sales times what? 100. So AMA margin, AMA over sales times 100. Coffee margin, coffee over sales times 100. So gross profit margin to be what? The gross profit over sales times 100. That is the formula. Anything margin is that item over sales times 100. Margin simple means profit expressed as a percentage of sales. That is the meaning of margin. So anything margin is that item over sales times 100. So if it's a gross profit margin, then must be gross profit over sales times 100. Good. So first formula will be gross profit over sales times 100. That is the gross profit margin. So gross profit over sales times 100. Anything margin. Then operating profit margin will be the operating profit over sales times 100. But here the operating profit that we are talking about is a profit before interest and tax. So this one, it will be profit before interest and tax over sales times 100. That is operating profit. So the operating profit that we are interested in is a profit before interest and tax. Good. So basically, now we move on to the net profit margin. Since we said anything margin is that item over sales times 100, the net profit margin will be the net profit over sales times 100. And then the net profit that we are interested in is a profit after tax. So if I should bring the net profit onto, it will be profit after tax over sales times what? 100. That is the net profit margin. So net profit margin is this. And we move on to the returns. Now, margin simple means profit expressed as a percentage of what? Sales. What about markup? Markup is a profit expressed as a percentage of what? Cost of sales. So we should also have opposite. Can also have gross profit markup. Is a gross profit over cost of what? Sales times 100. Can also have operating profit markup, net profit markup. But that one is not asked before, though. I've never been seeing some of the books.
Net profit
Over at the cost of sales. Yes. Not sales, but rather cost of sales. So basically, that is it. So we can continue. Then what about ROCE, the return? ROCE, I can do it here. ROCE is equal to profit employed. ROCE, return on capital employed. So it's equal to profit before interest and tax. Profit before interest and tax all over capital employed times 100. However, capital employed is equal to equity plus non-current liability. Equity plus non-current liability Good. Someone is asking, what if sales is not given? If sales is not given, we cannot get the margin. Good. However, if sales is not given, that means we cannot get any of the margins. We can't calculate the margins. So that means the only profitability ratio that we can still calculate is the ROCE and then the ROI. Good. So if sales is not given, we cannot determine it. So based on what they're giving us, that's what we can calculate. Good. Then return on equity, the ROI, is equal to antipart profit after tax over what? Equity. Over equity times 100. So times 100. Now in exams, two things will happen. Yes, the paper they are going to write on Tuesday. Either the examiner restricts you to do some selection for you to talk about, or he will leave it open. For a restricted question, you have no option than to do what he has requested you. But if it is open, I could talk about everything here. No. Select two. At least one margin, one returns. One margin, one returns. So select operating profit margin versus what? Receive. You are done. So this is your best two. So make sure that these two there, they must be part of you. So all the solution that we have provided in your handout plus the intervention kit, revision kit that we have provided, go through and make sure that you've read all the commentary about the ROCE and operating profit margin. And if at least you've picked some 2 or 3 points about it, you've picked 2 or 3 points about it, so that in exams, when you write, you can remember any of these points and then bring it up. Good. So that is it. We are done with the formulas. I hope it's okay. Clear. So that is it. Okay. Now we are going to the next ratio. So here two ratios, unless otherwise stated. If they don't tell you, select just two. This guy and this guy. You are done. This guy and this guy. Okay, let's go to liquidity ratios. Liquidity ratios. So
Can we
liquidity
with this
ratios. Good. So liquidity ratios. Yeah, this ratios talks about the ability of the entity to generate enough current assets to cover its current liability. The ability of the entity, to generate enough current assets or short-term assets to cover, to settle, to combat, to settle, to cover its short-term obligations or current liabilities. That yes, you can select any. Yes, is the ability of the entity to generate enough short-term assets to cover its short-term obligations as and when they become what? Payable or crystallized or fall due. Liquidity is said to be good. Liquidity is said to be good. Liquidity is said to be good. Liquidity is said to be good if the short-term assets of the entity exceeds the short-term assets exceeds or the short-term assets are enough, exceed or enough to cover the present obligation. The present obligation. The present obligations. That's liquidity. Good. I will come for this point when I reach there. Liquidity ratios originally there are two. Originally there are two. One, current ratio. Two, quick or asset test ratio. So these are the two originally liquidity ratios. Okay, so let's look at the formula. This one, we are just asking if you can pay your short-term debt as and when they fall due. Yes, your short-term debt, your payable, your bills, your suppliers, where there's time for you to go and pay them, you'll be able to handle your payment. So current ratio, as the name suggests, current. So it's current over current. So current ratio is current asset over current liability. So yes, current assets divided by current liability is to what? 1. Is to 1. Is to 1. Now the 1 is a relative measure. For every 1 Ghana cedi current liability that you have, how many assets do you have to combat it? If you calculate, let's say 2.5 is to 1. That means for every 1 Ghana cedi debt or every 1 Ghana cedi current liability, you have 2 cedis, 50 pesos current asset available to combat it. You are safe because your current asset are more than what? Your current liability 2.5 times. Good. That is the meaning. Here the benchmark normally range from 1.5 to 2.5. Here the higher the better. The reverse is true. The higher the better. The reverse is true. Too much of it is bad. The benchmark range from 1.5 to 1.5 is to 1 up to 2.5 is to what? 1. So that means we calculate and you get between these two figures, the company is doing well or it's okay. If you get below this, danger zone. If you get above 2.5 to, they are doing too well, which is so bad. Too well is also bad. Why should you have more current asset than you need? Another constant harm to yourself. Your inventories are high, receivables are high than you need, like 5 times than you need. No. Why can't you invest and manage your short-term assets well? So that you not spend much cost on it. Imagine that your inventory, your warehouse is full and still buying goods. It's full, you're still buying. You're still buying, hoping that maybe shortage will come and then you will now freeze your surpluses to gain revenue. Forgetting that these goods you have to what? Rotate them and then store them at additional cost. So that is it. You are done with the current ratio. If it's too high, that means you have more than current asset that you need. You have more than like 2 times, 5 times, 6 times, 8 times, 20 times. However, this benchmark, we have to be a bit careful. This is for a trading company, normal trading. Those that sells low value item, provisioning, those stuffs, good. Now, if you take industry like real estate, for them, they will have like 200 is to 1. That doesn't mean that they are doing too good, so it's bad. No. It depends on their industry. If you take real estate, the major land and building form part of their major inventory, but that's what they buy and sell. And then they have little current liability. So normally their liabilities are long term. They are the loans that they pick to sell the land and building for sale. So they have little current liability. Look at the value of land and building. as divided by the current liability. You can get more than 200:1. That doesn't mean that they are doing too good, so it's bad. No, that's their nature. And again, in exams, the examiner can provide you industrial average. You go to the exams and you see the industrial average, the examiner put 2.5 there. That's what you have to use. That's the industrial average. You go to the examiner put 3.5 there. That's the industrial average. That means the industry that the company found themselves, their sector average is what? 3.5. And that's what the examiner has calculated for you. In that case, you don't need to come back and come and code this one for us. For the examiner have given you what? The sector average already in the question. If the sector average has been provided, use that one as benchmark. Good. You don't use this. This is for a different industry. Sometimes the examiner try as much as possible to move around the tradition. So normally what they do is they normally give 2.5, which is in line with this. We are done with the current ratio. Let's go to quick ratio. Now with the current ratio, it just answer the question, can you pay your short-term debt? Yes, no. That's what current ratio answer. Then the quick ratio will come and then define it. Tell us more about it. So how fast, how quick can you pay your short-term debt? So that's what quick ratio will answer. The question of quick ratio will answer. So here, what are you going to use to pay your short-term debt? That's the current asset. What's the composition of current asset? Inventory, receivable, and then what? Cash. This is what we are going to use to pay our what? Current liabilities. So this, if our basket, this is our basket that we're going to use. In this basket, inventory, receivable, cash. Which of these will slow us down? We are looking for fastest way to pay our suppliers. Fastest way to pay what? Our current liabilities. So if there's any item which we have included in this basket that will slow us down, let's take it off. So 3, inventory, receivable, cash. So this 3, inventory, because if suppliers is on our neck, we can't tell them they should give us some time. Let's go and sell the goods. They ask us, what we go, nobody buys. What are you going to tell us? Even receivable, if someone is owing you, come tell the person, okay, someone's owing me. I'm going to take the money and come and settle you. It's a bit okay. If you now, I want to give you too much pressure, go and sell the debt, factor the debt, and then get some proceeds. Good. For a bank, most banks don't use receivable. They just pay the cash. Because when the customer probably draw up a check, can you tell the customer that please, someone is owing us a loan. So wait, let's go and take the loan and come and handle your check. Not at all. That's what I call it demand deposit. It's not a fixed deposit where we tossing the customer. So for a bank, if they are assessing their quick ratio, or they call it cash ratio, cash what? Ratio, because we are just picking the cash that we have divided by our deposits and see whether if everybody should come to the bank today, can be able to pay them their deposit. That is how we assess the quick ratio. So if it's like this, then the formula must be this. The formula is equal to current asset. Take away every item that will slow us down. So for a trading company, it's our inventory that will slow us down. So less inventory, all divided by what? Current liability is to what? 1. That is the formula. So that's why we subtract what? The inventory from it. Perfect. Why do we use the word acid? Acid because acid is what? The fastest reaction. Yes. Most often, when I catch international thieves or international criminals and they want to extract truth from them, they normally use acid. So what they do is they just pick a pen like this, dip it inside this acid small, cook, then put it in the head slightly, small one, automatically all the truth within some few seconds, all the truth from head to toe will come out. So if these people can use acid to extract truth within the shortest possible time, then we are asking that within the shortest possible, how can you pay your debt fast? Not that like some people they really respond to calls. If you call them as if their hand was on the on the answer key or answer pad, immediately the call goes through, see them they've responded. That's a quick ratio. Yes. So that is it. We are done. Now here the benchmark is what? Is 1:1. Again, this benchmark they can also change it in the exam question. So check whether they've given it to you or not. So we are done with the liquidity ratios. That's all. So this is the calculation. We are learning the formulas very well, and then at the end of the day, we now provide the reports. Then we are okay. Now let's see. Let's go to the next set of ratios. I'll do only 4 out of the 5 ratios. Good. The next set of ratio is the efficiency or activity ratio. Efficiency or activity ratio. Efficiency or activity ratio. Good. Okay. So a question here, asset test ratio. Okay. So with the asset test ratio, we are saying that how fast we can what? Pay our suppliers. How fast can we pay our suppliers? How quick? The current ratio, just answer the question, can you pay your suppliers? Yes, no. Yes, no. And the quick ratio, if yes, the quick ratio will now go further and say how fast, how soon, how immediate can you pay your suppliers? So that's what quick ratio assess. So if there's any item that will slow you down, please take the item off. And one of them is inventory. So that's why the formula is current asset minus what? Inventory. All over current liability. Good. Okay. So now we can go to the efficiency or activity ratio. So efficiency or activity ratio. Efficiency or activity ratio. Efficiency or activity ratio. So activity or efficiency ratio. Now these ratios measures 2 items. One, the ability of the entity to utilize its resources very well. How efficient are you using your assets that you have? So ability of the entity to utilize the resources efficiently. One, to generate to generate to generate cash and what? Sales revenue or revenue for the organization. Sales revenue. Sales revenue. So activity or efficiency. No. So ability to utilize the resources well to generate what? Cash and sales revenue for the operations of the organization. So you can see that some of the organization And they have a lot of assets, big resources. But if you see their sales revenue, small one, as if they're working for someone. But some organization, they have little assets. The online traders. Some of them doesn't even have an asset, not even shop. But the sales that they make a day, a week, is far, far, far bigger than someone who have full set of operating facility. Good. So that is so this guy is very efficient. If you see the asset and the sales, so this is your asset, this is your sales, this is your asset, this is your sales. You're not doing well. If I turn it upside down, this is your asset, this is your sales. Wow. This is your sales, this is your asset. Yeah, doing well. Little asset, you can turn it around to generate what? Money for the organization. That means you're being efficient. So these ratios, you check it. So the guy that can generate what? Profits and the one that can generate liquid cash. So two items here. And I'll explain this again when I read I'll refer why I ring this one and this two. So let's take a look when I read there. Let's look at the ratios under it. Let's look at the ratios under it. So efficiency, there are 5 in number. There are more than 5, just that we have summarized them to be 5. Out of the 5, we also need 2 or 3. Do not calculate plenty ratios. Because even if you calculate all the 23 ratios, you're not going to enlarge the max. The largest scale factor is 1. 1. You have inventory turnover. Inventory turnover period. Inventory turnover periods. Or just inventory turnover. Now, inventory turnover. This one explains how long it takes you to sell your goods after purchases. When you acquire your goods on credit, how long does it take you to sell after purchases? So after you acquire your goods, so the duration that takes you to sell, or how long it takes you to replenish your stock, replace the stock, or the number of times you go to the market. The number of times you go to the market. Okay. So that is the inventory turnover period. The formula is equal to your average inventory, average what? Inventory, all over cost of sales times 365. This is period. This one we call it period. You can measure inventory turnover in periods. We also have it in times. In what? Times. Good. So we should check notes. In times, just turn the formula upside down. So if the examiner, you only use the times if what they have calculated for you is in times. So the times, turn the formula upside down. Somersault it. So it will be cost of sales over what? Average inventory. Don't multiply by anything because it's in times. That's all.
Please, say no.
This is in times. You can also express inventory turnover in times, not only in periods, like in periods, how long it takes you. Sometimes you express it, the number of times you go to the market can also be used. In fact, in olden days, that's what normally they use. They say that when they go, yes, the olden days, when they go and come, they put one stones there. Every market, they put one stones there. So if you go like 2 times, you put the stones there. I don't mind, you count all the stones. Wow, you went to the market 5 times this month, 10 times. Good. Here, if it's in period, the shorter, the better. The reverse is true. Please don't tell the examiner that the reverse is true. Mm. In periods, the shorter, the better. Because ideally, it should take you shorter periods to sell your goods. If the goods are taking long period, why? Are you selling tractors or buildings? So that is it. But if it's in times, that one, the higher, the better. Very, very true. Time simple means the number of times you go to the market. So ideally, all other things being equal, the one that goes to, if all of us are selling the same thing, and someone was able to go to the market 5 times a week, we went just twice. So the one that went more will have what? More profit. Good. So that is it. Now there's a rule here that we have to look at it carefully. That's the average inventory. How to find average inventory? Average inventory. Average inventory is equal to open inventory plus closing all divided by 2. Open inventory plus closing all divided by 2. Average inventory. So here we said that there's average inventory in. Average inventory, average inventory. Is the open inventory plus the closing inventory all divided by 2. And is it. Now, if the open inventory is not given, then the average inventory is equal to the closing inventory
Open inventory
plus closing inventory divided by 2. If the open inventory is not given, don't assume that is 0. So if the open inventory is not given, do not assume that is what? 0. But instead, just pick the closing inventory as what? The average. That's all. If you assume that is 0, then that means you are going to divide the closing inventory by 2, which is wrong. So just pick the closing as what? Average. Now let's back with illustration. Let's go to Akwesi Papa Limited. Akwesi Papa. Let's go to Akwesi Papa Limited.
So if average is not given,
If Akwesi Papa here. If we check Akwesi Papa Limited. Now 2017, we cannot get what? Open inventory for 2017. So inventories here. So that means in that case you have to use what? 11,600 as the average. But the average inventory cannot be determined. So
but this one has open inventory.
we have to calculate the ratios for both years. In calculation of the ratios for both years. So at this, assuming that you are going to calculate the inventory turnover. So I'll do that one alone. In calculation of the ratio, this is how we want it. This is how we want it. You first of all write the ratio here. There are 2 years, so 2017 and what? 2018. The formula must be in. Here we are interested in the formula. It must be in. So the ratios will be here, and the formula will be here. 2017 will be here, and 2018 will also be here. So if I'm calculating inventory turnover days, then so the formula, the more I put, the more I remember. But this question I cannot get what average. So I have to use the closing inventory. So I tell the examiner that just inventory all over what cost of sales times 365. That's
Are
what.
we using that case paper?
Yes, Akwesi Papa Limited. Because for 2017, I cannot get open inventory. 2017, we can't get open inventory. Yes, the previous year, we can't get open inventory for the previous year. Even if they give us 2016, we can't get open for 2016 too, in that order. So definitely, there will be a year that we cannot get what? The open inventory. As a result of that, we cannot find what? Average for that particular year. So you just have to pick the closing inventory, which is 11,600 all over the cost of sales of what? What was 60,000 times 365. Now, when you go to 2018, even though 2018 you can find what? Average. But because 2017 we did not use the average, yet we cannot use average. That's the rule. They must be of the same base before we can compare. Good. Because 20 what 17, we are not able to calculate the average. Even 2018, if we can find it, we can get average, we should not use it because it will be of different base. Yes, closing, yes, average. You cannot compare. They must be of the same base. So therefore, in 2018 too, we are not going to calculate what average. We just pick the closing inventory. So the closing inventory will be 6,800. Good for that of 2018. So 6,800 over 48,000 times
I
365.
thought that
Good.
all inventories in there.
Once we give you years, BOM is one of the year you can't get average, so you have to use the closing throughout all of them. Except for we give you 3 years and ask for just 2 years. Or we give you 2 years and you are just calculating the current year. That one you can get average. So let's take note. If they have given us just 2 years and then they say we should calculate just 1 year, then now we can get average. So now we have to find average. But if we're calculating for all the 2 years, we can't get average. So we have to move on. So that's how we selected this over here. So this is how you do the. Then you write the answer here. All of them here. Then you leave one line. Then you underline it. You go to the next ratio on the list. Then you continue. Okay. Let's go to receivable days. The rest they follow the same rules, so I'm a bit fast there to write our report. So two, receivable collection period. Collection period. So receivable collection period talks about how long it takes the organization to collect its cash after sales. So after sales, how long does it take the organization to collect the cash? Receivable collection period. Receivable collection period. So how long does it take the organization to collect or receive this proceeds from the credit sales? So here too, the shorter the better, the reverse is true. So at least it should take us shorter period to receive
To collect or receive what?
to receive the proceeds from credit sales, cash from our credit sales. So it should take us shorter period to receive our money.
The shorter the better.
The shorter, the better. The reverse. Good. Now, with the receivable collection period, the formula is equal to as usual, average trade receivable all over credit sales. If there's no credit sales, you pick total sales. Credit sales times 365. If there's no credit sales, you pick total what? Sales. Then you are done. Here the benchmark is 30 days. We are saying that on average, if you sell, you should take a shorter period to receive the money. Now we said the shorter the better, the reverse is true. Too much of it is bad. Too much of it is what? Bad. If you are chasing your customers as soon as they buy the goods, a time will come they will not buy from you again because they'll get someone that will give them comfort and relaxed moment to pay the amount. So we should also take note of that. We are done with the receivable collection period, benchmark of 30 days. Here to the average rule applies here. Average rule applies here. So you should take note of that. If average, open plus closing, if you can't get the average, just pick what? That of the closing. Number three. Number three. That's the payable. Payable. Here we payable payment, right? We have to pay payable payment period. The payable payment period. And is equal to average payable is equal to divided by here they are item one. We want credit purchases because it is the credit purchase that result payable, not total purchases. So first we want credit purchases. But most of the financial statement prepared won't give you enough information. So sometimes you cannot find the credit purchases in the financial statements. If there's no credit purchases, then two, try and see if you can find what? The total purchases. So total purchases. So if there is no credit purchases, select what? Total purchases. Finally, if there's no total purchases too, you can't find it, then you find or you look for cost of sales. Cost of what? Sales. Look for cost of sales. Okay. Then look for cost of sales.
If all of them are in there,
If all of them are there, you select the credit purchases. This one must be the first one in that order. Good. So pick credit purchases. Because it's the credit purchases that will result average payable. And then that is it. Here the benchmark is 45 days. So if you buy someone's item, it should take you ideally 45 days. So that is the benchmark, 45 days. All these benchmark, like I said, there's other can change them in later. Good. So we are done. Let's move on to the last item on the list. So in calculating to the same thing, you code the ratio here, write the formula, key in, final answer, the next ratio. So receivable days, the same thing. average receivable. If I can't find average receivable, I just write receivable and then divide it by what? Sales revenue. So you should take note of the ratio calculation. At this stage, getting to the exams, all what you have to do is you pick your calculator and then you go through the materials, the ratio that we have calculated, you are going to audit it. You take your calculator and see. Add the points whether it's the same as what they have in there. If you find any difference, quickly go and then analyze what caused the issue. Okay, they use this formula. Okay, then you are fine. That is it. If not, we are going to probably go through a full set. No. What if that full set is not one time? So just issues in there. The last one that we will do, number 4, right? This is number 3. So let's go to number 4 for the last one. Number 4, we call it CCCC, Cash Conversion Cycle. Cash Conversion Cycle. That's number 4. Cash Conversion
It's
Cycle.
also under activity.
It's under activity ratio. Activity ratio. This one is the number 3 and number 4. Cash Conversion Cycle. We also call it net operating cycle. Net operating cycle. Then another one, we also call it cash operating cycle or net working capital cycle. So any ratio that have cycle, the cycle. Now here, it explains items such as convention. It just explains how long it takes the organization to convert investment in inventory into cash through sale. So how long it takes the organization to do what? Convert investment in inventory into what? Cash. So if you sell a product, for instance, if you have used all your investment to buy a product like this, and then you're going to probably sell it. So how long will it take you to recoup whatever you spend on this? That is the cash conversion cycle. So cash conversion cycle means it starts from you buying the goods. So buying the goods, how long the goods will take with you, you sell it to the next customer. Customer will take his time to pay small. So how long will it take to convert the investment in inventory into what? Cash through sale. But that's so you cannot get the cash. After getting the goods, the inventory, if you don't sell them, the money will not come. So how do you convert your investment into cash? Through what? Sale. That's the cash conversion cycle. And that one, the shorter, the better. Because you take a shorter period to recoup your investment. You don't want business where the goods it take you like 5 years before you can start recouping something. No. You like within few time you should be able to convert any inventory into what? Into cash through sale. That is the cash conversion cycle. It's critical in the learning. Good. The monetary version of this is what we call the amount of working capital needed for the organization. That's the monetary version. This is equal to the inventory days plus receivable days less payable days. Less payable days. Yeah, so inventory days plus receivable days less payable days. Good. So this will give you what we call your net working capital. The monetary version of this is what we call the cash or the amount of overdraft that that company or that organization needs, not what they have requested for. So some organization they've requested for maybe 50,000 cedis, but you going through their financials, they just need 10,000 cedis. According to their financial, they need 10,000 cedis. If you give them 50,000 cedis, they might end up not using it well. So that is it. We are done. 11 then we are done with the activity. The last one, another activity. Number 5. Call it net asset turnover. Net asset turnover. Net asset turnover. Here, it just explains how you use your assets. How do you turn over the assets? Use them to generate what? Revenue. That's all. How you use your asset to generate what? Revenue. Good. How you use your asset to generate revenue. The number of times the company uses its asset to generate revenue. The number of what? Times. So the number of times the company uses its asset. So that is it. So if you have about 5 seats in your total vehicle, and someone to also have, let's say, 35 seats. So ideally, if each person pay 5 seats, we are expecting that the one that have more assets, they will generate what? More revenue. But sometimes not like that. Good. Okay, so the formula is equal to sales that you can generate divided by your net assets. You are done. Net worth assets. Here we don't multiply by anything. The answer is in times. Okay, good. So here don't multiply by anything. And then what do? You leave the answer in times. So if you calculate to get, let's say 5, just add times to it. So to be what? 5 times. If you calculate to get 4, it will be 4 times. Here the higher, the better. The reverse is true. No benchmark. Yeah, if it is high, it suggests that in fact you're using your asset very well. In such company, they maintain the asset well. So don't wait for their vehicles to lock or break down before they can repair them. Mhm. Before they can repair them. Good. Yeah. So basically, that is it. Now we are done. So net assets, the activity ratios are 5. Select 2. Here we can also have non-current asset turnover. What will be the formula? If net asset turnover, the formula is sales over net asset. Then the non-current asset turnover will be what? Sales over non-current assets. If net asset turnover is sales over net assets, then non-current asset turnover will be what? Sales over non-current asset. What about net total asset turnover? Total asset turnover. Sales over total assets. That is it. So let's take note of that. Good. Now looking at the past exams, the common ones that they asked are the one that I am striking them out for you. Profitability, I've strike 2 out. Liquidity, all the 2. Here too, we strike some 2 out. And then any section that we go, we pick 2, 2, 2, 2 there because you cannot calculate all of them. So those 2 that I am hammering them, just pick one of the right type, go there, and then know more about it. Then you are fine. Okay, so basically, that is it.
So you say we should go to the
Great. So that is the activity ratio. Now, one thing about activity ratio is this. When it came on this set, it doesn't, but didn't do it at all. We have checked all the ratios under the activity between liquidity and profitability. We said activity ratios. They are the how the organization what generates, use the asset to generate what revenue. That's profitability and what cash. I circled this one. I said we'll talk about it. So that's what I'm going to talk about. So efficiency is how you use your asset to generate what revenue and cash. So it means that we can share all these ratios, all these five ratios, you can share them. Because revenue talks about profitability, cash talks about liquidity, liquid. So the first four, this up to this, can be part of liquidity. But that's how you generate money, cash. So if you see books, other material, putting inventory turnover period under liquidity, don't be surprised. It's as a result of this. But original liquidity are only two. Then the turnovers, asset turnover, will also be used for what? Profitability. So if you see books adding asset turnover under profitability, you shouldn't be surprised. Or in the exams, maybe classifying asset turnover under profitability, you shouldn't be surprised. That is it. So we've shared all the ratios of activity. None of them remain. We've shared all of them. So the first set goes to what? Liquidity. Last set goes to then profitability. Good. Then we add them. So here to select your best two or best three. First, inventory days. I don't know the one that is good for you. You have your capacity. So that's why we've done all of them. Select two. Please don't select all. I do not do all for you. But one thing is this. Maybe the one that you have selected, you go to the examiner to ask a different thing. The one that you know is also asking different thing. Over here, net asset must be part of us because the other sections is the only one that is a bit okay. Okay, look at that one. Then out of these three, you select any one. That's all. Select any one. Receivable days, inventory days, payable days versus what net asset. Normal here is for professional marks. That one. Then select your two. So this and this, or this and that. You are done. Okay, let's go to the last set of the ratio. For the market position, I'll just talk about this more. But I'm going to gearing. Gearing. So gearing. Then we write our report. And that's the end of ratios. Gearing. Gearing ratio. Gearing ratio. Gearing or long-term solvency or stability. These ratios, they just measure about three items. One, proportion of debt in the capital structure of the organization. So the gearing ratio measures three items. Number one, proportion of debt in the capital structure. So gearing. Gearing ratio. So number one, it measures what? The proportion of debt in the capital structure. Number two, it also measures the risks, financial risks facing the organization. Financial risks. Now, the financial risk is the risk associated with debt. Anybody that have gone for debt, even if it's one city, financial risk is chasing you. So, examples of financial risk. Tell us in your report, solvency. Because I'm not like solvency. Tell us that this gearing ratio analyze financial risks, such as what? Examples of financial risks. One, bankruptcy. 2, default risks. Default, default, default risks. Bankruptcy, default risks. All these are what? Financial risks. They are the risks that are associated with debt. Now, the efficiency also measures what we call operating risks. So there are two types of risks in the ratio: financial and what? Operating. The operating risk is being measured in what? The efficiency. Good. Financial risk is measured in gearing. Then number 3, the solvency of the organization. How solvent? Some organization, when they start servicing their debts, they can't even pay the employees again. So how solvent the organizations are. That's why most financial institutions check the solvency and see whether they can add their own to it. We are done with this. So let's go straight to the ratios here. Here the ratios here are not many. We look at some 2. Just 2. Even though in the handout I provided I think 5 or so. We call them 2. Ratios on the list. Number 1, debt to equity ratio. Debt to what? Equity ratio. Debt to equity ratio. Yeah, it's equal to debt over what? Equity times 100. Debt means non-current liability, long-term debt, not the current, no. But this one, Jeremy talks about long-term solvency, not the short-term. Short-term debt is what? Current. And that's the current ratio or the quick ratio. Times 100. Here the benchmark is 100. If you calculate in the exams on Tuesday, and then the answer that you get is more than 100, then the company is what? Highly geared. If it's less than 100, it's lowly what? Geared. And then if you are highly geared, that means the financial risk has also what? Increased or it's also high. If you are lowly geared, your financial risk is also what? Low. That is the highly geared and lowly geared. That is it. Now, increase in this debt to equity ratio suggests that this company, they are either repaying increase or decrease. Means either you are repaying the debt or you are going for additional facility, which is increasing the debt. So increase in this ratio means you're going for additional what? Debt. Now the second one, they are the same, but just that they are coming from opposite direction. Debt to equity, debt to capital employed ratio, debt to capital employed ratio, debt to capital employed. We also call it small gearing. So when I ask for gearing ratio, so gearing ratio is equal to the debt over equity plus debt times 100. So the debt is non-current liability or long-term debt. So the debt is non-current liability or long-term debt. That is the debt that we are talking about. Okay. This one, the benchmark is what? 50%. So let us be a bit careful so that we don't submit ourselves. We don't submit ourselves. If you calculate this and have, let's say, 70, it's not highly geared. The first one, it's not highly geared because the benchmark for the first one is what? 100. You should get more than 100 before the company becomes what? Highly geared, which is highly risky. But for the small gearing, that one, the benchmark is 50. Even if you get 60, it is what? Highly geared. So that means these two, they are talking about the same item. Yes, the one is coming from 100% point of view, and one is coming from 50% point of view. So let's get the distinction. Do not come and calculate this and go with this one as interpretation. Or calculating this using this one as an interpretation, no.
This at the top is what?
Debt over equity plus debt times 100. The debt is the non-current what liability. The first one, that one is debt over equity alone. Okay, so the next one that I will do is interest cover. Interest cover. Interest cover. The interest cover just explain the number of times your profit before interest and tax can pay what your interest expense. The number of times your profits can pay your interest. That's all. So number of times your profits available to pay interest can pay the interest for you.
No, right.
The number of times the profit can pay off the interest. So that's the interest cover. Number of times that you can cover the interest expense that you have. So for every one Ghana cedi interest, how many profit do you have to cover it? It's like insurance cover. Good. Just like the liquidity. So here is equal to your profit, which is available to pay the interest. Which of the profit is available to pay the interest? That's the profit before what? Interest and tax. There's the PBIT all over the interest expense, which is same as finance cost. We don't multiply by anything. We leave the answer in what? Just in time. So if you get 5, put 5 times here.
Interest expense.
Good. If you get 4, you say 4 times. Then that is it. Now, the issue is that here the higher the better, the reverse is true. Too much low suggests that shareholders' dividend is at risk. If you are not getting money to pay the interest, you get money to pay the dividend. No. If the profit is not enough, even though you don't pay dividend out of profit, but the profit will determine the dividend that we should pay. If this year all our money were taken away by the debt holders as way of interest, we didn't get money to go and pay the what shareholders as dividend. So if it's too low, tell the examiner that it's too low. So shareholders dividends is at what? It's at risk. Good. We are done with the calculation of the ratios. I'll leave market position for us to go and write the report. How to go by the report. Now we've gone through the calculation. Here to select just 2. The 2 are 1, the debt to equity. Here we like debt to equity versus interest cover. So these 2. Just that I added another one where if they don't give you the profit and loss, you might not be able to get what the interest and then PBIT. Because all this one they have to give us the P&L. This is the P&L. But sometimes they don't give us the P&L. So we normally use what you call debt to asset ratio. So I brought something to replace this so that you can get your 2. Because to me, you can't calculate these 2 at the same time for me. Now mark all the 2 for you. I only mark 1. But they explain the same item. So you pick 1, come and pick what you call debt to asset ratio. So debt over total assets. It just explains proportion of the asset being financed by what debt, as you saw in the common size. Yes. So that is it. We are done. So that's all.
So when we are not able to get the parameters right.
Let's look at question 2, Uncle. If you check Anko, there's no P&L. No P&L. If you check last sitting two, there's no P&L. Last sitting question two, there's no P&L. So in that case, how do you get your solvency ratio? And here you are, you can't calculate these two for me. I'll pick only one. So what do? So that means you can only get one. So I brought additional one that we can calculate so that at least we get our 2, 2, 2, 2. We are done. The additional one that I brought was debt to equity ratio. Debt to what? Sorry, debt to asset. Debt to asset ratio, which is equal to debt over what? Total assets times 100.
Times 100.
Yeah, times 100. So times 100. That's the debt to assets. So to just replace situations where no P and L. If there's P and L, just pick this one and then move on. Great. So writing the report itself. So now we've gone through how to calculate the ratios, how to pick the items one after the other. Now after calculation, I will not be surprised if you go to the examiner have calculated all the ratios for you and that's to write the report. That'll be very good. That'll be very good. They've done everything for you. A question like that, fourth lot. That's I see a super important.
That one, we expecting a lot of money.
Yes, they've done all the calculation for you and they've increased the marks of the report. That's very good. We have increased the marks of the report and then we've done the calculation for you. You don't need to increase, you don't need to do any calculation. There's no financial statement. They'll give you maybe 2 companies or 3 companies and they arrange it nicely for you. So these are companies and their financial and then their ratios. Maybe 3 companies. 3 companies, they are here. So company number 1, A, B, and C. So Zamina, Yomali, and Zamsi. Good. So they'll calculate operating profit margin 30%, 25%, 26%. They've done the calculation already. They go to proceed, the key ones 25%, 13%, 14%. You are done. They go to current ratio 2:1, 3:1, 1.5:1. They are done. And they ask you to write the report. It's not the same, it does not change. Because what you do, you just need this ratio to provide an interpretation. So let's start. In that case, what do you do if they've done the calculation already for you? That you have to like expect to do more because they've increased, they've piled up all the calculations in the report they are going to write. Good. So let's see how we will do that one. Okay. So report writing. Now the report writing will take form like this. It will not be just empty. One, it will be might be a report. Report 2, memo. 3, briefing paper or briefing note. Briefing paper or briefing note. 4, commentary. Comment. 5, explanatory. Explain the performance. 6, analyze or analysis. So So this is how your question will be. Yes, if we take all ratio questions on this earth, we come through this. These are the form that we put them. Either you're writing a report or a memo, a briefing paper, or a briefing note, or you're running commentary, or explaining the performance, or analyzing the performance. So these are the various sections. Good. So we will look at the first two. That's where the issue is. Each of them have its own format that we have to go by. Good. If it is report, go by report approach. If it is memo, if it is just commentary, go by commentary. If it's just analysis, just provide analysis there. Briefing paper or briefing notes. Prepare a note, explanatory note, or briefing note to the management explaining the performance of Zangi Limited, performance of Fadama, performance of what Impunju, performance of Anko, and performance of Akwesi Papa. Good. Now let's start with a report, a memo. They alternate. So I'll look at the report first. Look at report first. The format, please. This one, they don't need any structure. This commentary, explanatory, analyze, like last it is own, no structure. Last thing, it wasn't a report, so we don't expect you to provide a report for us. It's not a report. Last thing was just analyze. So just start the analysis. No structure, no from, no to, no date, no subject. No, we don't want to say that. It's just analysis. So this is what we will do. So this one, I'll bring it back again. Yes, I'll bring it back. If it's a report, it's all right, report on top. How do you know there's a report? Let them tell you. Write a report to the CEO of Akwesi Papa Limited. Write a memo to Akwesi Papa Limited. Write a briefing note stating the performance of Akwesi Papa. Comment on the financial position of Akwesi Papa. Explain the performance of Akwesi Papa. Analyze the performance of Akwesi Papa. These are different. So report, you start from two, from date, subject. You can use the last question in the handout for practice. Good. So let's see. Two, they will tell you who you should write the report to. Yes, write the report to the board of directors. Good. We have memo, and then we have the report. Now, ideally, this is the report format. The memo, just swap this. Just that organizations may have their own structures on how they write their memos. Because normally memos are for internal circulation of information or announcements or policies or idea or budgets. Good. So organization can twist it to suit how they want their things to be done or culture it a little. Good. So if you raise this one, sometimes what we face is this. Different group will tell us that this is how they do it. Them two will tell this is how they do it. Uh-huh. All of you are what? Correct. Just that. Stick to one for us. Two, let's say board of directors. From they have to address us. They'll tell you as a consultant, they write your consultant there, your consulting name. Target professional consult. I'll put it there nicely. If they don't address you as a consultant, don't. They can tell you that as a financial controller, so financial controller. As account officer, account officer. As credit control officer, credit control officer. If they don't address you, please address yourself. Oh yes. You have to address yourself. The best address you can give to yourself is your full name. So your full name, Frank AJ. Your full name. It doesn't address you. Date, please, the date. This one is the date of the examination. That's the date they are writing the report. So from now to Tuesday, let Tuesday's date be part of it. Anything you are doing, write it. You want the official date format, not the informal. So the date must be, if you want this one, 12 of what? January 2021. Not 2020. Past 2020. Please, the 12th. Don't do this. Raising the power TH.
Hey,
That one is a computer writing, not human being writing. It's a computer writing. It's a computer that when you tap this, you get it up for you. So it must be TH. Step the TH down. Or if you don't want trouble to, then go by this. January 12th, no punctuation. 2021. Yes. January 12th, 2021. That's okay. What we don't want to see is this. 12 like this. 01 2021. This is not official date format. This is not official date format. So let's take note of that. I will not tell you the marks to discourage you. Then you go to subjects. Yes, subject, just summarize the requirements. The requirements say write a report to analyze the performance of Akwesi Papa. So analysis of performance of what? Akwesi Papa. Or performance analysis of Akwesi Papa. So here performance analysis. Performance analysis. So performance analysis. Then we are done with it.
performance analysis.
Of Akwesi Papa. Of the company in question. Company in question. Akwesi Papa Limited. Akwesi Papa Limited. Please, for purpose of examination, all your reports and memo can you introduce the reader. By reality, most memos does not have introduction. Most of the memos, but for internal information, you are just passing an announcement. You don't need to introduce it. It's not answer. But for
The reader, as in the two.
like the memo, in reality, like internal memos normally does not have introduction.
Oh, okay.
Yes, but for a purpose of examination, whether memo, whether report, introduce, write introduction, whether report, whether memo. For report here, you cannot write a report without introduction. Report is official document, so it must bear what introduction. Good. So let's write our introduction, body, conclusion, and that's the end of the report writing. Good. So
So do we underline or we leave it?
yes, subject. Well, this is okay. Other people to write it the way they write their official letter. So they bring it in the middle in capital letters and underline it. A good presentation is in the last question in the handout. So let's go to the last question in the handout and look at how we provided it. And there's another question to Obia. They check the first question and the last question, how it was provided. Good. The very last question. Okay. I'm talking about. Question 3. This is the one I'm talking about. This is the one that's coming from the examiner. Question 3. That's October 2017. It's question 3. The question I'm talking about is question 3. Okay, let's write our introduction. Our introduction. So from here, the next line is introduction. Yes. That particular question. How they wrote the report. That one is coming from your exam directly. That was the math mistake.
So we write introduction.
Yes. Some write, some to leave it. So in some cases you can write, some cases you leave it. Good. So let's look at the introduction. 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 This introduction must be brief. One paragraph, not two. Over here, one. It must be what? Brief. Introduction must be brief. First, it must contain 3 sentences, at least, or maximum 3 sentences. 3 sentences. So your introduction. Please and please again, I repeat, you need these structures if it is what? Memo and report. You go and you say commentary, analyze, like last it is own analysis. No, this structure. You go straight forward and just provide the meaning towards. Okay. So first sentence, number 1. Tell us the purpose of your report. Purpose. Sometimes it's for decision, to include a decision. The steps, analyze the performance of the company and recommend whether the facility should be granted to this customer or this company. So such a question, you need to include the decision in the introduction. So purpose, like this. Usually, you keep the first sentence brief and so lovely. If the examiner added a life to the question, you should also have a life to your what? Your introduction. If the examiner give the question raw, the introduction must also be what? Raw. Less. For instance, some of the question you see a letter in the question. Letter. They say one Monday morning you open your mail and this is what you saw in the mail. Good. Hello, credit control officer. Yes. I went to the last board meeting and then the board of directors have requested us to prepare a report about the company for performance for the next board meeting discussion. So kindly furnish me with a report. Good. Thanks. Below is the financial statement gathered. Full stop. Such a question, the examiner started the question with a life with other items. So you can also start raw like that. So also start like this, as requested, or per our last discussion, or per the meeting, per the suggestion or request by the board. I am writing this report to provide analysis of this company. Good. So normally start like this, as requested. If those stuff are not there, just go straight for it raw like this. This report seeks to analyze or evaluate. This report seeks to what? Analyze or evaluate. This report seeks to analyze or evaluate. Analyze or evaluate or assess the performance of Akwesi Papa. Akwesi Papa. For 2017 and 2018 financial year. Now, we don't end here. We'll come and end it. Let's discuss it. Sometimes the question to ask you, the question will be a decision question where your boss is asking you to write a report in whether you should grant the facility to the customer. So that one, you have to include it that I'm writing this report to analyze the performance first and suggest and recommend whether the facility should be granted toward this customer. When the examiner is a decision, please include a decision. For instance, Cash Burger just arrived from abroad and upon arrival is looking for profitable company to invest its proceeds gathered so far. He has heard of 3 companies, Zamina, Yomali, and Zamsi. Good. And has presented them to you to advise which of these 3 companies he must invest his funds in. Such a question is the decision question. You have to tell us in your report that you analyze this performance of these 3 companies and suggest which of them Cash Burger should invest his what proceed in. How we get it? So you are responding directly to the question that we've asked you. It will be like whether it's a decision or not. You are writing report to analyze the performance. What are you going to use it for? So if it is a decision, continue with the decision and recommend whether the facility should be granted. Good. And then that is it. Then that's the first sentence. We are done. Let's go to sentence number 2. Sentence number 2. It must be brief. Tell us the type of report you are doing, type of report, or type of analysis. That's all. And the key ratios. So sentence number 2 basically talks about the types of analysis and the key ratios. So sentence number 2 talks about types of what? Types of analysis and the key ratios. Types of analysis and the key ratio. Type of analysis and the key ratio. Type of analysis and the key ratios. Type of analysis and the key ratio. So sentence number 2. Let's go to sentence number 2. Sentence number 2. The report must be brief. If you go as no report, it's just analyze. We don't need this structure. So number 2, type of analysis / types of ratios. Tell us, there are so many types of analysis or so many types of ratio. Maybe the question was general. Now you tell us the ratios that you selected so that when you deviate, we can change you and then deduct it from you. Good. So type of analysis or the types of ratio that we're going to talk about. So that one, there are 2, basically, there are 2 types. Under ratio, there are 2 types. Under what ratio? Good. Even if it is a common size and if asked you to write a report, using common size, write a report, the same structure. If you come here, the common size we mentioned here, because the types of analysis is what? Common size analysis. Using trend analysis, a type of analysis will be what? Trend analysis. How we get it? Good. But sometimes you see 2 companies, they will use ratio, company A and company B. That's one set. Still ratio, the same company, 2017, 2018, like Akwesi Papa. Okay. So this, let's assume that scenario A and then scenario B, this one, how do you write the reports? So you tell the examiner that the analysis will be based on what? either intercompany comparison. That if you see two companies, in there, the analysis is based on what? Intercompany comparison. The analysis is based on what? Intercompany comparison. If it's the same company but different years, that examiner, the analysis is based on what? Trend analysis. Or the report will be based on trend analysis. The report will be based on what? Trend analysis. Using the following key ratios. So I will start. The analysis will be based on trend or intercompany analysis. The report will be based on what? Intercompany analysis or trend analysis. Please don't need to write both because only one will appear at a time. If you see the question, there are 2 years, you are going to talk about 2 years. That's intercompany comparison. If the question you're going to talk about just one company but different years, it's called trend. And this is intercompany comparison. And one of them will surely pop up in exams. One of them will surely pop up in exams. So if it is intercompany, this report will be based on what? Intercompany comparison using the following key ratios. They name them profitability, liquidity, gearing, like that. So the one that you're going to talk about, the key ratios, good. Then you add that. So that is the sentence number 2. Then you go to sentence number 3. Sentence 3. At least tell us one key limitations of your analysis. One key limitation of your analysis.
That's sentence 5.
Sentence 3. The sentence are 3, or the points are 3. 1, the purpose or decision. 2, type of analysis or ratios. And then the 3, one key challenge or limitations of your analysis. So you can tell us that if it is intercompany comparison, comparing two companies, tell us that my analysis or this analysis is limited to what? This analysis is limited to selection of different accounting policy by the companies. If all of them select different accounting policy, you are done. Good. So one key challenge. So my analysis is limited to selection of different accounting policy. Then if it's a trend, change the accounting policy. Good. Then we are done. Then we go to the main body. This is how the main body should look like. The main body. The main body of the report should contain the main points that you want to talk about. First, you say you're going to talk about profitability. Write it here. Profitability. And align it. We need just 3 paragraphs. The first paragraph, she talks about profitability in general. Second paragraph, she talks about the first ratio that you selected. So first one, profitability in general. Second paragraph, she talks about the first one that you selected, maybe operating profit margin. Then the third paragraph, she talks about maybe the ROCE. That's all. So 3 paragraphs under each of the key ratios. That means if you go and select 3 ratios, you have to have extra paragraph for it. That's why you have to select just 2. First paragraph, maybe 2 sentences or just 1. This one talks about the literal meaning of profitability. So here the point that we gave, about profitability, that's what that's right there. So what you've written right now, the point about what? The profitability, that's what you tell the examiner. Profitability assess the ability of, you mentioned the company's name, Akwesi Papa, Amafric, Uhu, or the entity to what generate enough profit for each what operations. You are done. Go to the next one. In terms of operating profit margin, you pick it, then you explain it. So assuming that you see, I'm going to talk about three ratios, three key ratios. When you're done with profitability, the next line or the next paragraph, you write liquidity here like this. Underline it. First paragraph, talk about liquidity in general. Second paragraph, talk about first ratio, current ratio. Then you talk about quick ratio. But why do you use the general? In events where the analysis does not go on well, rely on the general to give you. So do like this until you are what done. So don't write plenty. No, not plenty talk. So that's why I like your examiner's questions. It doesn't ask plenty ratios. Usually two. Solvency and liquidity. So they don't write plenty. So the paragraph will be just six. The body is just six paragraphs. You are done. Then you go to conclusion. So after the final one, conclusion. Now with the conclusion, usually that's why you make the decision available. Some of the questions are decision. So in the conclusion, that's where you conclude. Please, before I go to conclusion, let me give you the most important section about what goes into the each of the key ratios that you've selected. Now, only 4 points we are requiring from you. 4.4. What we saw under the trend analysis, the same thing we are going to do here. Number one, tell us whether there has been a change in the ratio. Number two, what does the change represent? Meaning of the change. So when gross profit margin increases, what does it suggest, good or bad? And number three is reasons, assign reasons. What do you think will be the main cause of the good or the bad performance? Then finally, 4, what will be the impact if this continues? And recommendation, what will be your recommendation? So if you pick each of the ratio, that's what I'm going to say about it. That's the main paragraph over here. So you pick operating profit margin, say in terms of operating profit margin, it has increased over the period, which represents a good performance. This is as a result of what? Efficient control of what? Operating costs, given or reducing the operating costs over the period. You are done. If this continues, the company will improve its what? Profitability position. That's all. Okay, so this is what will form part of the main interpretation. This is the main interpretation. And it will be the second and then the third paragraph where you are talking about the actual ratios. Good. Now let's go to the conclusion. So the conclusion, there are two sides of the conclusion. We have the decision conclusion and we have that of the general conclusion. With the question decision, your boss asks you whether you should grant the facility to the customer. You can't go and then give the boss, I'm done the analysis, so based on it, make your decision. No, they ask you to make a decision. So now put yourself or yourself in a position of making such decision. So what do? All what you have to do is check whether the liquidity position and solvency is good. If it's good, then they should grant what the facility requested. So you tell them that based on the above analysis, the facility requested should be granted unto Akwesi Papa, pending what? Further qualitative analysis. Yes, what they're giving me is financial. What if these people, their characters are not good? It's not appear on the financial. So I can't see that one. So what they've given me there, based on what they've given me, grant them the loan. But uh, do your further analysis about the qualitative aspect. I did not give it to me. Go ahead and do that one. Because if they don't have a good reputation, I will not see it on the balance sheet. P&L does not reflect good reputation, and it must translate into the payment of what? The facility. So that is how you end. Then, what if it's a general conclusion? Okay, general conclusion simple means you're not making a decision. They just ask you to what? Analyze the performance. So that one, you tell the examiner that from the above analysis, the overall performance of acquisition paper has been improved, good or bad, despite certain or one or two ratios going down. They name the ratios that are going down. You are down with your conclusion. So that is the end of the conclusion. Please and please again, after conclusion, sign and write your full name with a report. So after conclusion, sign. So want to see your signature. Sign for us, okay? And then your full name, Frank AJ. Frank AJ. Good. Because in reality, normally when you are done, write your title. AG, Finance Officer, Finance Director. But here we don't want title. Just write your full name. Good. So that's the end of the game. Yes, at the right side, right? Yes, right after the completion. It can also be at the left side. Yes, because some people write their own at the left. Others would also write their own at the right.
Sorry, Joseph. We are doing